inflation isn't dead, it's just evolving. As billionaire investor Paul Tudor Jones once warned, inflation is not transitory. It's likely to be much more embedded and persistent. And today, that warning is proving prophetic. The latest CPI report shows core inflation easing, but headline inflation has now risen for the second month in a row, driven largely by fuel and utility costs. That's not the kind of trend that gives the Fed confidence to start cutting rates. In fact, it reinforces the idea that inflation may be morphing, not disappearing. In this environment, the market's optimism is bordering on complacency. Yes, equities are at all-time highs. Yes, earnings season is off to a strong start, but beneath the surface, risks are rising. Energy prices are climbing. Tariffs are back on the table, and the labor market, while softening, is far from weak. The Fed knows that rushing to cut could repeat the policy mistakes of the past, and Jerome Powell has made it clear they won't move without a durable downtrend in inflation. This complex backdrop has created a new kind of market, one where policy volatility, AI disruption, and strategic cost optimization are defining winners and losers. It's not enough to just ride the index anymore. Investors need to look deeper toward companies that are innovating through uncertainty, driving efficiencies with AI, and gaining relevance in sectors where pricing power matters. And that brings us to today's lineup: 3 fast-growing companies that are thriving in this moment. They're adapting to inflation, absorbing tariffs, and using AI to unlock explosive growth potential. First on the list is a company that's redefining what modern healthcare looks like: Hims & Hers Health Inc., ticker symbol HIMS. While many telehealth platforms are still stuck in reactive care, Hims is leading the charge with proactive, personalized health solutions, and they're doing it with style, scale, and serious momentum. Their subscription-based business model gives users access to custom treatments across mental health, sexual wellness, dermatology, and now weight loss, all from the comfort of home. But what really makes Hims stand out isn't just its product range, it's the leadership's vision. CEO Andrew Dudum has laid out a strategic roadmap that's aggressive but grounded in data. The company's embracing AI-driven tools like MedMatch to enhance initial care, launching precision coaching programs, and even planning expansion into international markets like Canada. That's no small feat, especially when you're simultaneously maintaining one of the highest gross margins in the sector. And with monthly revenue per subscriber and order volume both trending higher, this isn't hype, it's execution. Hims & Hers reported a staggering 62% compound annual revenue growth from 2019 to 2024. They're projecting another 56% to 63% for this year alone. And despite skeptics pointing to regulatory risks or stiff competition, the company has continued to adapt, moving quickly to diversify offerings and minimize reliance on any one product, such as compounded weight loss medications. So, what's the real story here? This is a company in its early growth phase, riding the megatrend of telehealth, while building a defensible moat around personalization and digital-first healthcare. While traditional metrics might say Hims is overvalued, they simply don't capture what this company could become in the next 5 years. With a strong brand, growing subscriber base, and AI-infused strategy, Hims & Hers is not just a disruptor, it's shaping up to be a long-term category leader. Next up is a company flying under the radar, but quickly becoming a force in the world of AI-driven advertising: AppLovin Corporation, ticker symbol APP. What started as a mobile gaming ad platform is now transforming into something far more powerful: a performance marketing engine supercharged by reinforcement learning and real-time data. At the center of this transformation is Axon, AppLovin's proprietary AI platform that's quietly setting a new standard in ad tech efficiency. In its most recent quarter, AppLovin posted $1.5 billion in revenue, a 40% year-over-year surge, with adjusted EBITDA margins above 68%. That's not just growth, that's profitability at scale. But here's the real story. AppLovin's core advertising segment is delivering $1.16 billion in revenue at 81% margins, thanks to Axon's predictive power. It's not about pumping out more ads. It's about delivering smarter, better targeted ads that generate results. And it's working. Churn among top web advertisers is under 3%, even in early-stage verticals like e-commerce. The company has sold off its legacy gaming assets to focus entirely on this AI-driven future. It's now rolling out a self-service ad console set to unlock a massive wave of demand from hundreds of advertisers waiting to onboard. That shift, from managed services to scale scalable AI-powered automation could redefine how long-tail advertisers compete with giants like Meta and Google. With AI at its core, AppLovin is applying gaming's instant feedback loop to more complex verticals like insurance and fintech, where customer journeys are longer and stakes are higher. It's not without risk, of course. Incumbents have scale, and attribution in non-gaming sectors is harder. But AppLovin is embracing that challenge with precision. Their model doesn't need oceans of user data to win. It needs results, and so far, it's delivering. AppLovin may not be making headlines like the tech titans, but behind the scenes, it's building an AI engine that could quietly power the next generation of digital advertising. Let's wrap things up with a semiconductor giant that's making serious AI waves, Advanced Micro Devices Inc., ticker symbol AMD. Now, it's easy to look at NVIDIA's dominance and assume the AI chip race is already over. But here's the truth. AMD doesn't need to dethrone NVIDIA to be a massive long-term winner. Under Lisa Su's leadership, AMD has carved out a credible and accelerating path in the AI infrastructure boom, and the market is finally starting to catch on. After a tough stretch earlier this year, AMD has roared back, outperforming even the broader semiconductor ETF since February. And the catalyst? A growing belief that AMD's open-source, full-stack AI approach, spanning CPUs, GPUs, and software, isn't just real, it's working. While NVIDIA's CUDA ecosystem remains the standard, hyperscalers like Meta, Oracle, and even OpenAI are now actively deploying AMD's AI silicon. That's a huge vote of confidence, and it's just the beginning. AMD recently launched performance claims showing up to 4 times improvements in AI compute and a 35 times boost in inference. These are not just PR numbers, they're functional enhancements aimed at real-world enterprise workloads, especially as we move from data center-only AI to agentic AI and AI PCs. AMD is rapidly scaling with hyperscalers, and as AI compute demand diversifies beyond the largest platforms, AMD's adaptability could be its secret weapon. And here's the kicker. If AMD manages to push AI revenue from $5 billion to $20 billion over the next few years, that's transformative. Given its smaller base, every billion in AI sales means more to AMD than to a behemoth like NVIDIA. This isn't about replacing NVIDIA. It's about staking a lucrative corner in a $750 billion AI infrastructure market. With strong product momentum, strategic partnerships, and a leaner cost structure, AMD is on track to become an indispensable player in the next phase of AI growth without needing to be number one. In today's rapidly evolving market, it's not just about chasing the biggest names. It's about identifying the next wave of winners riding powerful trends, whether it's revolutionizing healthcare access, transforming ad tech with AI, or building a strong foothold in the trillion-dollar AI chip race. The companies we discussed are doing more than just surviving. They're innovating, scaling, and leading from unexpected angles. As macro headwinds like inflation, tariffs, and Fed uncertainty continue to stir volatility, it's clear that adaptability, efficiency, and vision are what will define the next generation of growth stocks. Stay focused, stay strategic, and remember, in a market that rewards bold execution, early conviction can make all the difference. If you found value in today's insights, make sure to like, subscribe, and drop a comment on which stock you believe has the most upside in this AI-driven landscape.